I'm back.
All right. Today is Wednesday, June 1st, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and apologies for the absence. I gave it my best shot, didn't happen, but I appreciate all of you, all the messages, the kindness, and I love all of you, and damn it, you're gonna make me cry now. Anyways, a lot of things happened since we talked last time. For example, the breaking news that we got today, finally, at last, justice for Johnny Depp. He can finally relax and get himself a mega pint. And I hope that all of you got to enjoy the long Memorial Day weekend, and hopefully you were not one of those people who got stuck in the airport when thousands of flights got canceled. Hopefully you were smart enough and you opted for driving instead. It's more comfortable, no crowd, no waiting, and it's a lot cheaper too. Whoops! Wait a minute here. Never mind. Because gasoline prices reached all-time highs in the United States, and driving during a long holiday weekend can be a little dangerous. For example, Nancy Pelosi's husband, Mr. Pelosi, the insider trader, well, he got in trouble over the weekend because he got caught driving under the influence. DUI on the record, baby. And he got arrested. But I have sympathy to Mr. Pelosi because if I was married to Nancy, I will be drinking and driving every single day. But folks, if you have your hopes high that your boy, Joey B, is going to tackle the inflation problem and all of these insane gasoline prices at the pump, unfortunately, the conversation in the White House over the weekend went as the following. Come on, man, get these prices down. Mr. President, you've already released all the gas from the strategic reserve. We got nothing left anymore. Come on, man, I got a lot of gas to release from my barrels. Get it done, fat. And speaking of farts, you know why I love this country? Because it appears that every month we have a holiday of some sort, and I can use that as an excuse to take a day off. And I'm not just talking about President's Day, Martin Luther King Day, Memorial Day. I'm talking about the National Whatever Day, National Donut Day, National Pizza Day, National Car Wash Day, National Fart Day. Yep, it exists. January 7th, baby. And I went to my boss and I said, hey, I identify as a fart. Can I take the day off? He said, no, get lost. So I ended up hotboxing the entire office. You know what else is going on? The 80s are coming back. And no, it's not the boomers who want the 80s back. It's actually the Gen Zers. Yep. Matter of fact, the Gen Zers, they don't like to drink at all. They prefer smoking, how do I say this without triggering the Algos police? I was going to say, what was he saying now? They prefer relaxation over drinking alcohol. They also like Stranger Things, which is based on the 80s, and now 80s music is coming back. Not only that, but guess which movie is at the top of the box office right now, here, in the year 2022? Yep, Top Gun, once again. So the Gen Zers are bringing back relaxation from the 80s. They're bringing back 80s music, 80s movies. What else? Perhaps VD will make a comeback. Oh, never mind. The Gen Zers don't even have sex anymore. Matter of fact, 40% of Gen Zers say they never, ever got laid. And only 1%, 1 out of 100, said that they get laid at least once a day. And here's a picture of the guy who said that. Anyways, we got a lot to talk about, so let's move on. And here it is, in focus tonight. Biden versus Powell. Is it finally happening? Is Joe Biden finally realizing that Jerome Powell is his biggest political enemy? You know, in this channel, we talk about inflation being always a monetary phenomenon. What does that mean? It means that the source and the origin of inflation has always been the Federal Reserve, not the supply chain, and certainly not any particular administration. Because regardless of the fiscal policy, what enables the fiscal policy to spend like crazy is the monetary policy. For example, across the globe, you have inflation rampant. In the US, in the UK, in Germany, in Indonesia, in Brazil, in China, pretty much everywhere inflation is moving higher. But these countries happen to have different administrations, different policies, different leanings. Some are liberals, some are conservatives, some are spending like crazy, some are not. But regardless, all of them are suffering from inflation because inflation has always been a monetary phenomenon. And here's a little secret for you. It's not just a monetary phenomenon. It is the Federal Reserve. So it doesn't matter if the central bank of Sweden or Norway, whatever, prints like crazy or doesn't print, doesn't matter. If the Federal Reserve of the United States prints like crazy, inducing inflation in the United States, that inflation will be contagious worldwide. Why? Because commodities across the globe are traded via US dollars for the most part. If we do have inflation in the United States, inflation will be contagious across the globe. And hence, when the United States sneezes, the rest of the world catches AIDS. But today we had President Biden meeting with Jerome Powell in the White House, and this is a rarity, of course, because we have the separation, at least on paper, the separation between the White House and the Federal Reserve. But unfortunately, there is no separation between the Federal Reserve and the oligarchs at Wall Street, because that kind of corruption is not only legal, but it is encouraged. It is the American way. Capitalism, baby. Yet, what's really interesting about this meeting is the fact not only that Joe Biden is running out of options to tackle inflation, but he is also running out of boogeymen to blame for this inflation. The so-called Putin price hikes, that did not land at all. The majority of the American public knows that it's not the Putin price hike. Inflation has been going on for a while, even before the war. So now, finally, Joe Biden is blaming the right guy for this inflation, the Fed chair, Mr. Jerome Powell, aka Mr. Transitory, aka Mr. Dangerous, aka the guy who did not even use a formula to guide his inflation target. And we wonder why we got here? It is because this incompetent fool that is leading the Federal Reserve right now. And of course, Joe Biden shot himself in the foot when he renominated Jerome Powell to lead the Fed for another term. I mean, if I up this much in my job and I get to keep my job, oh, wait a minute, that's a dream. Not in Jerome Powell's world. He gets to keep his job. Why? Because the oligarchs who actually lead and control this country told Joe Biden, we want Jerome Powell. We want to keep Jerome Powell. He made us so rich by initiating the largest transfer of wealth in human history. And in essence, Joe Biden ended up renominating his biggest political enemy. Matter of fact, last year in October, I tweeted this, Biden is dumb for saying he has full confidence in Jay Powell. Voters will blame inflation and the upcoming market crash on Biden, not Powell, even though inflation is a monetary phenomenon. We are already seeing this right now. Look at these two guys in the White House, tense. Look at Jerome Powell. He's sitting there thinking, when can we go back to print, baby, print? No, he's not going to use the cushion that the economy has right now with the low unemployment rate to normalize the monetary policy by increasing interest rates and inducing minimal damage to the economy, as minimal as we can have at this stage, because he should have raised interest rates last year, but the economy still has some cushion right now to absorb the shock. But of course, Mr. Powell is a tool, a puppet for the oligarchs and the Wall Streeters, and he is obsessed with the stock market, and he's not going to do that at all. He's going to wait and hope that inflation is going to be transitory, and it's going to sort itself out. What's going to happen is stagflation will persist, the economy will weaken on its own, and by the time he realizes he needs to normalize the monetary policy and increase interest rates higher, that unemployment cushion would be gone. And then the economy will get a massive direct hit from the Federal Reserve that could create a prolonged recession, if not a depression. And this battle becomes really interesting because on one hand, you have Joe Biden, who is now 100% laser focused in beating inflation. Why? Because we got elections in November around the corner. And if inflation persists by that time, the Democrats will get absolutely wiped out of the map. Republicans will end up controlling the House and the Senate, and nothing will be passed in the so-called Biden agenda. Comes 2024, we say goodbye to Joe Biden, assuming that he's still alive, and here comes you-know-who. On the other hand, you have Jerome Powell, who is controlled by the oligarchs and the Wall Streeters, who is obsessed with the stock market, who is still concerned about the stock market, not the economy or inflation. So you have two guys, one concerned about inflation because his ass is on the line comes November. You got the other guy concerned about the stock market because His ass is on the line when it comes to the oligarchs and the Wall Streeters who are always interested in pumping stocks at any price. So who will end up being victorious here? Because if anything, Joe Biden is presenting Jerome Powell to the American public and in an indirect way saying, this is the guy you want to blame for inflation. This guy, not me. That's not going to work anyways, because right now, for now, whatever the Fed does, it remains mild and the impact of increasing interest rates will not take effect until perhaps the fourth quarter of this year, if not next year. In the meantime, U.S. consumer confidence is dropping like a rock. We got the reading in the morning today that consumer confidence went down in May due to the stubborn inflation. On top of that, Americans from all walks of life are saying inflation is the top issue. Inflation is the main concern for this economy, not even jobs. Certainly not the thing, certainly not the war in Ukraine. Inflation is the number one issue in this country, and it's getting dire out there, folks, specifically for the Biden administration. In an ominous sign for Democrats, Powell says inflation the top issue for Latinos. Now, the Democratic Party always assumed that the Latino vote is in the bag. Not this time around. The Gen Zers are revolting. Young blacks are revolting. Young Latinos are revolting and saying, you know what? Inflation is killing us, and we are so dissatisfied with this administration that we're not going to vote for them anymore. And this will cost the Democrats and the Biden administration a dire price at the polls in November, and hence the meeting with Powell today. You think the separation between the White House and the Federal Reserve will prevent Joe Biden from telling Jerome Powell in a direct way, you gotta start tackling this inflation now? And you're not going to be able to do that besides raising interest rates dramatically, not just 50 basis points, and certainly no pause in September. Here's the problem. Powell would say, Mr. President, if I raise interest rates higher, more than 50 basis points abruptly, and I send a message to the economy and the stock market that I'm going to do the job in tackling inflation properly, like Volcker did, you know what the result would be, Mr. President? You're going to lose jobs before the elections. The stock market is going to crash before the elections. You're going to lose either way, Mr. President, whether I keep inflation high or whether I tackle inflation by being too hawkish on interest rates. So it is a lose-lose situation for Biden. What is Plan C? Because Plan A is not working. Plan B is not going to work. What is Plan C? How about straight out manipulating the data, straight out cooking the data, and hoping that the American public will buy the illusion? They're now saying that avoiding a recession may require moving the inflation goalpost. What does that mean? The Federal Reserve comes out and says, you know what? We decided that our inflation target is moving from 2% to 5%. And we're not that far from 5%. The core PCE, which is the bullshit reading of inflation that we like because it's bullshit and it's cooked, it's at around 7%. So perhaps by September, October, we get down to 6, 5.9, and ta-da, problem solved. We don't got inflation anymore. We're back at the target, baby. 5%. Meanwhile, you and I, the average Joe and Jane in the economy, are still suffering, paying an insane price for rent, utilities, gas, groceries. But for the administration, mission accomplished. We're done here. What inflation? What are we talking about here? No recession. No need to increase interest rates anymore. But it doesn't matter. Whether they manipulate or put a lipstick on a pig, that doesn't matter because the signs for a recession are already here. And the recession at this point is pretty much in the bag. The headline read, Wall Street perma-bear, and by the way, they call economists and strategists who are telling the truth about this economy perma-bears, as if that was supposed to be an insult. I say perma-bear is a badge of honor at this point. But anyways, perma-bear Albert Edwards highlights the recession threat hidden in retailers' earnings. We talked about that in details in this channel. We talked about retailers getting decimated by inflation to the point where they're not even able to pass the inflation cost all the way down to the end consumer. We talked about retailers seeing demand destruction by the consumer because the consumer is prioritizing their spending. They're shifting their spending to essentials: rent, gas, utilities, grocery store, and they're spending less on Walmart, Target, Ross, etc. Warning number 3 from these retailers is the fact that they assumed that stimmy demand will stick. You know, the myth of the strong consumer, and they ordered plenty of inventory. Now they have a problem where they got too much inventory while the demand is moving down. This is yet another sign for an upcoming recession. But rest assured, you got the folks at Goldman Sachs. They got your back. Fears of U.S. recession in 2022 are overblown, Goldman Sachs says. And you gotta trust the folks at Goldman Sachs because they're not gonna tell their clients, their private clients, anything different, right? Whoops! Goldman Sachs releases recession manual to prepare clients for a downturn. Uh-oh. But they want you to buy. They want the mom and pops to continue to buy the dip in the stock market and assume that the recession is just overblown. Not going to happen right now. Meanwhile, they're preparing their private clients for the upcoming recession because, once again, it's in the bag. And no, it's not just me saying that. You got Goldman Sachs CEO saying that there is a reasonable chance that the U.S. is heading into a recession and urges caution for big businesses. Matter of fact, he says 30% chance of a recession within the next 12 to 24 months. And it's not just the current CEO, even the ex-CEO warns a very, very high risk of a recession. But hey, the fears are just overblown. You see how these snakes on Wall Street operate? They got no integrity, no ethics at all. And remember this one from last week, Katie Stockton, who said the S&P 500 just flashed a buy signal. That could mean an oversold rally is on the horizon. And she was right. The MACD indicator flashed the buy signal. And since then, the S&P 500 has been moving higher. But here's the update from Katie Stockton, who now says selling in the stock market is likely to take over again after last week's rally as oil prices approach 2008 highs. So if you bought the dip, you know the deal. Always be closing. But rest assured, today oil prices shot up higher, significantly higher, over the fact that the European Union is shooting itself in the foot again by imposing an embargo on Russian oil. The problem is, what is the substitute? How will the EU secure oil supplies? We're talking about a massive amount here that they want to take out. Now, we're going to talk about this subject in tomorrow's video, but for now, rest assured that the Wall Street Journal came out to the rescue by releasing the fake news right before the closing of commodities trading by saying, hey, OPEC, some OPEC members, we're not saying who, but some OPEC members said that they want to kick Russia out of the supply agreement, which means countries like Saudi or the UAE could replace Russian barrels by pumping more. We all know that that's a fantasy. We'll talk about it in the commodities coverage, but for now, oil prices went down. So what does that mean? Does that mean that the rebound rally continues? Perhaps. But for now, the trauma among market participants is still here. The Dow finally bounced, the S&P bounced, the Qs bounced, the Nasdaq, the Russell bounced, all of them moving higher. Yet a lot of investors are still doubting that the bottom is in. Why? Because every time we get these rebounds for about a week or so, the selling resumes right away. And this is yet another indicator that we are indeed in a bear market. Matter of fact, the perma bears at Morgan Stanley say that the U.S. stock rally has limited upside. Pay attention now. The folks at Morgan Stanley say that this rebound could pause and reverse at around 4,250 or 4,300 on the S&P 500. So we got about, 4-5% to go? Maybe less than that. And then they say that the end target for the S&P 500 is at around 3,400. And we have an important test coming this week. The durability of U.S. stock market bounce in question as inflation worries linger ahead of payrolls report. So we're going to get the payrolls, I believe, on Friday, and that piece of information would be critical for the bounce. And in this case, good news is bad news. Why? Because if we continue to see jobs creation in the economy, and we continue to see the unemployment rate holding at a very low level, then that means that the Federal Reserve needs to do more to tackle this inflation. So again, good news is bad news. What you actually want to see is bad news. You want to see companies laying off employees. You want to see the unemployment rate moving slightly higher. Not by too much, but slightly higher. And there's a lot of pain out there, folks, specifically for the technology stocks, because this is the biggest annual decline in technology stocks in 14 years. We're just getting started, baby. Matter of fact, Elon Musk, Jeff Bezos, and Bill Gates lost $115 billion in 5 months. Look at all of these oligarchs. They're down big. Zuckerberg down almost $55 billion. Bezos down around $57.5 billion. And Reverend Elon Musk is down around $59 billion. And it gets even better. Remember the devil, the market manipulators at SoftBank? Well, the CFO pay is now down 40% after the company's VC fund lost $26.2 billion. These are the con artists from SoftBank. When the market is easy, everybody looks like a genius, case in point, Mama Kathy Wood. But now that the market is not so easy, all of that investing in growth at any price, well, there is a price to pay because valuations and rationale matter. What would cause this pain to be relieved in a sustainable fashion? The answer is if the Fed pauses. But we just talked about the battle between Biden and Powell. Biden is not going to allow Powell to pause because right now they're getting desperate. The Biden administration, they need to tackle inflation. So Mohamed El-Arian says investors may be hoping for a Fed pause to save them from higher interest rates, but that would be a big policy mistake. Why? Because El-Arian agrees with me that waiting for inflation to cool down on its own is a tragedy because it will not. It might dip, but it will come back higher again. And the Fed must use whatever left of the economic cushion that we have right now to start increasing interest rates aggressively. Do the 1% now. Do the 1.5% now while we still have the cushion. Because if you do that later on, when the cushion is gone, when unemployment moves higher either way, you know what's going to happen. A prolonged recession, a very deep recession, and God forbid it could be a depression. But folks, we have to end on a positive note because a lot of you are going to say, hey bro, what's up with the perma bear? What's up with the FUD, bro? Okay, I got some good news for you. Here it is. And it comes from the Landromat at JP Morgan. The Landromat says the stock market is close to finding its bottom as corporate share buybacks surge to record highs. Forget about the pause. Forget about Powell. Forget about Biden. Forget about everybody else. We got the share buybacks, baby. We can manipulate the stock market higher until November, of course, and then it goes down again. And they say that there are good signs because look at the semiconductor index, for example. This is the highest weekly gain, the biggest weekly gain, I should say, since March. So maybe there is something to this bounce that we haven't seen before so far this year. Maybe it is sustainable. Maybe it is going to stick. This is at least according to Elon culties, who are buying the dip with both hands in the souffle. In May, we have seen the strongest monthly buying of Tesla shares by retail investors since August of 2020, when the company announced its first stock split, says Vanda Research. Whatever the reason, anticipation for another stock split, the army of Musk fans doubling down after the Twitter deal, or just plain dip buying. There has been a clear uptick in retail sentiment for Tesla since the start of the month. Net buying of Tesla shares by retail investors in May was $708 million as of Friday, the second most among mega-cap technology stocks, trailing only Apple. Tesla was the top gainer on the NYSE FANG Plus index last week, the third biggest contributor to the S&P 500 index as it posted its biggest weekly gain since November 2020. Now, here's the good news. Remember what I said when I talked about the sustainability of the bounce? I said, number one, you need the dollar to cool down. We got that. Number two, you need the 10-year yield to cool down. We got that. Number three, we need to see some short covering. We got a lot of that. Number four, we need retail participation. This is an indicator that we got that. But here's the bad news. This is yet another indicator that we still have excess liquidity and excess speculation in the economy and the stock market. What does that mean? It means the Fed has to be even more aggressive in tightening the monetary policy. So if the Fed is serious about tackling this inflation, there is not going to be a pause. And if anything, they have to double down on the hawkish rhetoric by increasing interest rates by even more than anticipated. Otherwise, inflation is going to come back, and this is an indicator that inflation still has a massive tailwind behind it. There is still plenty of cash floating around, otherwise the retail mom and pop would have not bought the dip in Tesla shares. Anyhow, folks, we have to move on now and cover the stock market for you, and we start with the performance of indices today, and here we go! It was another roller coaster ride, up and down, only to end up flat or flat-ish. The Dow Industrial Average is down by 176.89 points, or a decline of 0.54%. The Nasdaq in the red by 86.93 points, or a decline of 0.72%. The S&P 500 down by 30.92 points, or a decline of 0.75%. The sector's performances led by number 1, number 2, number 3, capturing the gold, silver, and bronze. Energy, the only sector of the stock market closing in the green today. The rest Shame on them. And the wall of shame was led by defensives, healthcare, and financials. Here's the advance to decline ratios, and the breadth, by the way, is awful. And it was awful yesterday, so this could be a leading indicator that we have more pain to come. The NYSE 36% advancing versus 61% declining. The NASDAQ 33% advancing versus 63% declining. Moving on to commodities, and you might have noticed yesterday crude oil was up big, both the WTI and Brent, but specifically the WTI, which was trading above $120 yesterday, and then magically, moments before the closing of trading in crude, came the fake news from the Wall Street Journal and erased the entire rally altogether. And today, crude, be it the WTI or Brent, pretty much closed flat, yet we have massive gains for gasoline. Not good news for us consumers because gas is up over, or gasoline I should say, up over 3.5% today. Heating oil, another problem for the consumer, up almost 5% today alone. And here it is. Lots of pain to come, folks. If you think inflation is peaking, think again, because natural gas surged up higher by more than 7.5% today alone. And let's talk about energy news for a moment here, because the catalyst for the move higher in crude yesterday was two things. Number one, the fact that we're seeing a lift-off of the draconian lockdowns in China, specifically in Beijing and Shanghai. And this was a tailwind for crude to move higher, as we see a restoration of demand. We also got the news that the European Union is shooting itself in the foot again by banning Russian oil. What are they going to use instead? Coal? Anyways, the result was Brent hit 2-month high right away, and the target was $124 a barrel. Guess what? Brent was at $124 a barrel in a single day, right away. This prediction was during the summer. Brent will get to 124. It got to 124 yesterday, and then came the fake news moments before the closing. And the Wall Street Journal said some OPEC members, we don't know who, but some OPEC members are exploring the idea of suspending Russia's participation in an oil production deal as Western sanctions and partial European ban begins to undercut Moscow's ability to pump more. And of course, the assumption here, the article made it seem to be that we're going to see more supply in the market by players such as Saudi Arabia, maybe the UAE, going to pump more. This is baloney. We know that OPEC said we have a schedule, we have an agreement of increasing production by 400,000 barrels. But that is also subject to what's going on. If we have a slowdown in the economy, global economy, then maybe that's going to be off the table. And it doesn't matter which country that increase comes from, because it is capped, meaning you're not going to take away the Russian supply entirely and have Saudi Arabia pumping 9 million barrels a day. Extra. Not going to happen. They don't have that capacity. Nobody has that capacity. Whether it is Russia or Saudi or UAE or whoever pumps the extra 400,000 barrels, it remains the same. We're not going to see more supplies hitting the market at all. Matter of fact, the Saudis made it clear. The energy minister or foreign minister said that there is enough energy in the market and there is nothing more the kingdom can do to tame oil markets. And today, Russian Foreign Minister Lavrov was actually in Riyadh in Saudi Arabia, praising OPEC Plus. The relationship is on the up and up. No problems here at all. So what the hell is the Wall Street Journal talking about? They say, oh, it's anonymous sources. It is some countries. They're exploring. Who said that? Who's exploring? Either you name the names of your sources, name which members said that, or get lost. But this is the sad state of journalism in America. We have all of these papers, the New York Times, the Washington Post, the Wall Street Journal, all owned by oligarchs who have ties with the deep state, and they don't care about the facts at all. An anonymous source says, somebody said something, and they're reported right away as facts. And in this case, the purpose is clear: to manipulate oil prices down. Anyhow, what about softs? Lumber is down big. Over 7.5% today alone. Lumber was at around $700 yesterday before the market started trading here in the U.S., and now it's down big all the way to $600 almost. This is a massive decline in lumber and an ominous sign, by the way, for the state of the housing market in this country. And then we have another down day for cotton, losing about 2% today. Then we have sugar, flattish, with modest gains. On the other hand, we have sizable gains led by coffee. Coffee futures are surging, gaining another 3.5% today. And then we have gains for OJ. OJ closing the day with gains of over 1.5%. And then we have cocoa futures also scoring a little over 1.25% today. Metals, the dollar is up today, halting the rally in metals. Whatever rally it wasn't really that much of a rally, but it was a bounce. And now it is stalling, at least in gold. Gold pretty much flat for the day, but the gold bugs will take flat when the dollar is moving higher by almost 1% in a day. And then we got silver. Silver closing the day with gains of over 0.75%. Platinum remains the outperformer for the week, scoring almost 3% worth of gains today alone. And then we have copper. Copper also moving higher, but not as we expected after the reopening of Beijing and Shanghai. You would think that the demand of copper will recover. And on top of that, copper inventories are pretty much at all-time low. So we have all the tailwinds for copper to move higher. Why isn't it moving higher? We will see what the next couple of days have in store for copper. But here's the last one. Palladium is down almost 1% today. When we talk about meats, green across the board, and the gains are led by the new big tech lean hogs, scoring gains of over 4% today alone. And then we have gains of almost 3% for feeder cattle futures. And then we got gains for live cattle futures of almost 2%. But here's the problem. When we talk about poultry, you're going to pay more. The third biggest U.S. chicken producer said the average selling price for its chicken was about 34% higher than a year ago. Listen to this. While costs for feed were up just 14%, that drove its earnings to the best ever. So here we have an industry that continues to do price gouging. They're taking advantage of this inflation by doing price gouging, and the consumer remains receptive in this case. And before you say, hey, these are evil companies doing price gouging, the management has to stay on top of inflation. They have to stay ahead of inflation. So yes, price gouging is a normal phenomenon, a normal practice under inflation. Why are we complaining about it now? If you want to complain about anything, complain about the status of inflation in this economy. If inflation goes down, no more price gouging. They cannot do it anymore. But unfortunately for the consumer, it's not just chicken, by the way. It's also eggs. The avian flu did plenty of damage here. The prices of eggs are up over 20% year over year, and the reason is production is down all the way to the same levels of 2015, erasing multi-years worth of gains. And the average layers on hand also down to the same levels of 2015. So we got a massive shortage of layers and hence a massive shortage of eggs. You're going to pay more at the grocery store. No doubt about it. Now, let's talk about grains because we have some relief here for the consumer because in the last couple of days, corn and wheat down big. Matter of fact, wheat is down big and it lost almost 4.25% today alone. Likewise, corn is down a little over 3% today alone. So we're seeing some relief here based on the rumors that the Russians are going to allow some wheat and corn exports out of the ports in Ukraine. Likewise, we're seeing oats down almost 3.5% today, canola futures down a little over 2.5% today, and then we have rough rice down 2% almost, and then we have flattish activities in soybeans, soybean meal, and soybean oil futures. And the take for now is how long will the dip last in grains, but specifically wheat, because what if the rumors are wrong and the Russians are not going to allow wheat exports out of Ukraine anyways? Then we have this news as a tailwind for wheat to move higher. U.S. wheat crop hit by dry winter, then soggy spring, adding to global tightness. And when we talk about the hunger crisis, it's not just the Russia-Ukraine war. It's the rise of protectionism from food producers, in this case India. India says we're not going to export wheat anymore. And now the concern is, what if India bans the export of rice due to the shortage of corn and wheat and other grains? India happens to be the largest exporter of rice. Almost 40% of trade comes out of India, and the largest consumer of Indian rice is the Middle East, Arab countries, who are already suffering from the rise in food prices due to the shortage of wheat from Ukraine. So you're already seeing the impact on the Middle Eastern economy. And here we're talking about Saudi, UAE, Qatar, the countries with booming economies due to the rise in energy commodities. These markets, in the case of Saudi Arabia, for example, the Saudi stock market has been outperforming the US, the European, and the Asian markets, not even close. But recently, the Saudi stock market went down big, and the reason is the consumer has to pay more now for food. Food inflation is slowing down the booming economy in the Middle East. And now, if we have an export ban of rice from India, this is going to impact the Middle Eastern consumer even more because they're going to spend more on food, and now they got a shortage of rice. They have to get rice from another producer, and they're going to have to pay more for it, which means they're going to spend more stimulating the economy, spending on goods and services. And that explains the drop in the Saudi stock market, for example, as of late. But the point being here is, what is the other producer? What is the substitute for Indian rice? Well, you got Thailand rice, but you also got the U.S., meaning rough rice futures should be moving higher. We got a tailwind here for rough rice to move higher, assuming that India is indeed going to ban the exports of rice. When we look at rice futures, they've been lagging corn and wheat. Now we have a shortage in both corn and wheat. You got to substitute animal feed, for example, by using rice. So we're seeing the demand for rice moving higher. This could be the next one to pop higher. There is no guarantee, of course, but for that particular reason, the shift of demand from wheat and corn to rice keeps me long on rough rice futures. Moving on to the options market, the big casino, we continue to see the volume down, and we're not seeing buying of call options. Yes, we're seeing the retail crowd participating via buying Tesla, for example, the stock, but we're not seeing retail participation in a significant way that produces a mechanical push of the stock market higher. We're not seeing buying of calls. The put-to-call ratio remains pretty much at around 50-50, 60-40. Now, to push the stock market higher, we need higher volume all in all, but we also need to see the put-to-call ratio improving in favor of calls. You need to see 70% plus buying of calls. And this is not happening, at least for now. Regardless, Apple came at number one, the hottest table by far, at around 950,000 contracts traded for the name today. About 59% of those were calls. And at number two, Tesla, the souffle, at around 525,000 contracts traded today. About 52% of those were calls. And at number three, Amazon. See, Amazon is moving higher because we're seeing a combination of two things. Number one, the volume is higher. We're talking about over 350,000 contracts traded for the name today. And then we have the ratio favoring calls by a big margin. Almost 73% of the contracts traded today for Amazon were calls. So Amazon is trading higher. Now in the news, you'll hear, oh, Amazon is moving higher due to the stock split. Maybe that is the reason. But the mechanical reason behind the move higher is the fact that we're seeing buying of call options. We're not going to see the entirety of the stock market moving higher unless we see the same replicating in Apple, in Tesla, in Meta, in Google, in the large cap names, and this is not happening, at least for now. So we're moving on to the unusual activities that took place in the options market today. And again, notice not just the low volume, all in all, but also the lack of conviction, meaning if we have high conviction in buying options right now in the trajectory of the stock market up or down, we see larger bets and we see longer expiration dates. This is not what we're seeing for now, so we have a lack of conviction by options market participants. But regardless, here is XHB, the ticker for the Home Builders Index, and they're betting for more pain to come by buying the 56 puts for the expiration date July 15th with expectations that the XHB could go down by more than 9% by then. They paid around $1.20 a piece to enter this trade, all in all spending around $800,000. And then we have the ticker HPQ for HP. Now Warren Buffett, the big buffet, likes the name, and hence it is an outperformer so far, bucking the negative trend overall in the stock market. And here we have somebody bidding for more gains to come for HPQ. In this case, they bought the 45 calls for the expiration date, August 19th, with expectations that the name could move higher by more than 11.5% by then. And they paid around $1 a piece to enter this trade, all in all spending around $650,000. And then we have the ticker MRO for Marathon Petroleum. They're buying calls this time around. Energy happens to be the only consistent performer in the stock market. So here we have somebody buying calls, in this case the 33 calls for the expiration date, June 3rd, with expectations that the name could move higher by more than 5% by then. They paid around $1 a piece to enter this trade, all in all spending around $500,000. And then we have the ticker QQQ for the NASDAQ, and here we have somebody fading the rip, calling for the bounce to take a U-turn. In this case, they're buying the 280 puts for the expiration date, July 1st, with expectations that the Qs will go down by more than 8.5% by then. They paid around $3.40 a piece to enter this trade, all in all spending around $1 million. million. And lastly, at the bottom of the table, we have the ticker AMZN for Amazon. They continue to buy calls here. In this case, the 2,590 calls for the expiration date, June 3rd, meaning this upcoming Friday, betting that this mechanical squeeze will continue, and we will see Amazon surging higher by more than 6.5% by then. And they paid around $5.50 a piece to enter this trade, all in all, spending around $1.5 million. Moving on to the heat map analysis, mostly red across the board with exception of energy. Energy remains the outperformer all in all, but we're also seeing some green activities bucking the trend within the overall sector of the market. For example, materials are down, but we're seeing FCX copper moving higher. We talked about the reopening in China. This should be a good tailwind for copper to move higher. Likewise, we talked about Amazon, the mechanical squeeze, yet in the auto manufacturers, yesterday the Chinese auto manufacturers moved higher due to the news that China is reopening again, but we're seeing the rip in Chinese stocks fading away right away, be it Alibaba, JD, Pinduoduo, yet the auto manufacturers are moving higher. NIO, Li Auto, but mostly the Japanese names, the value names, Toyota and Honda. Very few exceptions in industrials, and then we have in technology, software, we have CRM, Salesforce moving higher, and this is due to a short squeeze because CEO Mark Benioff came out yesterday and said that the profit margin will be a lot better than expectations. So that's going to force a short squeeze. How long will that last? Well, if the overall sentiment in the market goes down again, then this will be fade the rip for CRM. Now, here's some corporate news for you. Individual names. We start with Qualcomm, a San Diego company, by the way, so I'm biased here. Actually, it is a Chinese company, but anyways, the CEO says that the market is making an absolute mistake on our stock. He believes that Qualcomm should be moving higher. We covered the earnings from Qualcomm. They look pretty good. The problem is Qualcomm is suffering from the ETFization impacting the stock market. When the ETFs get dumped, be it the SMH or the Philadelphia Semiconductor Index, the SOXX, Qualcomm will go down with it. And if a large component of these ETFs, say NVIDIA, goes down, Qualcomm will suffer too. This is the problem with ETFs in the stock market. And speaking of chips, what about NVIDIA? NVIDIA went down big, and here we have Mama Cathie Wood buying the dip, $44 million worth of dip. So here we got a new shorting idea. Thank you to Mama Cathie Wood. And then we have Netflix, and the war against the extreme wokeness in our society is raging on. And even corporations are realizing that you go woke, you go broke. And even Ted Sarandos is now saying, wait a minute here, we're going to continue to defend comedians, Chappelle and Gervais, because this is free speech. And free speech used to be a very liberal issue. He's right about that, by the way. It used to be the lefties who cheered for free speech. Now it's the opposite. Now it's the Democrats, the lefties, the liberals in California are the ones cheering for more censorship and more restrictions on free speech. Unbelievable what happened here. And Netflix is finally realizing that they're spending like a drunken sailor, and they cannot do that anymore. And now they're saying they're blaming all of this on The Irishman. They spent over $175 million making The Irishman. It's not just The Irishman. It's spending hundreds of millions of dollars to make one movie featuring The Rock or Ryan Reynolds or whoever. It doesn't matter. And then me as a consumer, I'm going to watch that in a day, and then what? I want to watch more. Well, you got nothing more. Now, you might read the headline and say, oh, finally, Netflix is waking up, and now they're going to spend, instead of spending $100 million making one movie, they're going to spend $100 million making 10 projects so they can appeal to more audience and they can feed my addiction, because that's what it really is. You're in the business for addiction. Nope. Unfortunately, again, Sarandos doesn't understand this game at all. This better and fewer mentality likely will not be super noticeable to the casual Netflix watcher, but it will also likely means less green lighting of small budget films. For example, instead of making two $10 million movies, listen to this, Netflix might opt for one $20 million movie that would hopefully be a lot better in terms of quality. Wrong strategy, Mr. Sarandos. Again, you're not getting the message here. You're going to spend $20 million putting all of your eggs in one basket. What if this content is not appealing to a wider audience? What if it is appealing, hypothetically speaking? What if it is a hit and I watched it in a single day? Now what? I'm looking for more. I gotta wait a couple of weeks, maybe a couple of months before I get another content. In the meantime, why am I still subscribing to Netflix? See what I'm saying here? You're better off creating more content, more frequency of content, and you can produce excellent quality content for $10 million. You don't need to hire the household names. You're in the business of addiction. More. We need more. In a single weekend, I can watch an entire series. And then what? But unfortunately, Mr. Sarandis doesn't understand that, and therefore, we continue to be negative on Netflix here. But we're not negative on the defense contractors. Matter of fact, I remain bullish on Lockheed, Raytheon, General Dynamics. Doesn't matter which one it is. I happen to like Lockheed Martin because we have a hypersonic missile race with China and Russia, and Lockheed Martin remains the leader here in the U.S. in hypersonic missile technology. But here comes the money laundering, the $40 billion plus that we're sending to Ukraine. The U.S. is buying more Stinger missiles after success, quote unquote, in Ukraine. What success? Are you kidding me? They're losing territory by the day. But here it is. The U.S. Army has awarded a contract worth up to $687 million to Raytheon Technologies for anti-aircraft Stinger missiles in order to replenish stocks sent to Ukraine. What does that mean? We have depleted our own stock. We sent our missiles to Ukraine. Now we have to buy more. Thank you to the genius politicians, the senile leaders, for making these decisions. By the way, Raytheon has to wait months, if not years, to finish manufacturing these missiles because we have a shortage of pretty much everything. In the meantime, what happens if the U.S. gets attacked? Whoops, we got high on our own supply. And then what about Moderna? We have bad news because here's the CEO, Stéphane Bancel.
It's sad to say. I'm in the process of throwing 30 million doses into the garbage because nobody wants them. We have a big demand problem.
So he says I have to throw 30 million doses to garbage. Why? Because here's the advertisement for your product, Mr. Bancel. Our dear beloved governor here in California, Kim Jong-un Newsom, well, he got the thing again, just 10 days after getting his second booster. And now CEO Stéphane Bancel, after dumping billions of dollars worth of stock, now he says he's going to give away most of his fortune to charity. And the charity is the Stéphane Bancel Foundation. Lastly, today we got the breaking news, that CEO of Meta, Facebook, Sheryl Sandberg, well, she's leaving. Goodbye. And I'm suspicious here because this is not arbitrary, meaning either, number one, Sheryl Sandberg got caught covering for her ex, Activision CEO, and she manipulated the data and the flow of news, the algorithm, to bury the negative stories about her ex. That is a massive scandal. So the easy way out is get the parachute and get the hell out. Jump off the plane. And that plane is about to crash, by the way. Reason number two for getting out, maybe, it is due to the lunacy of Mark Zuckerberg, who's going all in this metaverse stupidity, which is a glorified video game, by the way. And Sandberg perhaps doesn't agree. She thinks that the metaverse is not a good idea, so she's bailing out right now. Anyhow, moving on to the daily heat map for the ETFs. It is a sea of red, not major losses, but still in the red. We're seeing pain specifically in the XRT. It was down yesterday. It's down today, the XRT for retail. So we're seeing massive weakness here in retail. Every bounce in the XRT and these retail names is being sold right away. The only outperformer is energy, the XOP, XLE, OIH, all moving higher. Both growth and value are underperforming. The IWF, IWD down by an equal portion. We have commodities outperforming. The UNG for gas, and even gold miners and silver moved higher today. When it comes to the international ETFs, they're down across the board. Japan was slightly positive, and then we have Australia, the EWA, India, the INDA, the ticker, and the EWC for Canada also outperforming, but mind you, by outperforming we mean closing pretty much in the flat line. Flat is good when you see red activities across the board. Moving on to the charts analysis, and we start with SPY, the S&P 500 30 minutes chart. We opened higher again, facing the same resistance at 416. That was the second rejection right away, 2 days in a row, and the SPY lost 410 as support. It managed to make its way higher again above 410. That was positive, but it lost 410 as support by the end of the day. Now, is the action we got today in this chart from a 30 minutes perspective favors the bulls or the bears? The answer is the bears. Why? Because number one, the chart failed to crack above 416. This is the second day in a row. Number two, the chart lost 410 as support. Number three, it made it above 410, yet it lost it again as support by the end of the day. So the bears have the advantage in this chart. If the weakness continues, we're going down to close the gap at 405. That becomes support, and 410 becomes resistance. Now, when we zoom out to a daily chart for the continuous contract for the SPY, the S&P 500, what do we see here? Do we see any major negativity in this chart? Not really. We see the chart battling at the support of 4100 almost. The volume is down day over day. The momentum indicators may be stalling, but they're still positive. So the bulls would argue it doesn't matter what happened in the 30 minutes chart or the hourly chart. In the daily chart, even if we go down by a little more, what if this is an ABC pattern? We formed the A leg, now we're forming the B leg, the retracement, and then comes the C leg, which will take us all the way to 4300. This is entirely possible. So the bears better be careful here. You want to trade the 30 minutes charts, the hourly charts, but always be closing. You buy puts, the chart goes down. It doesn't break below 3,960. It doesn't lose that support by the end of the day. You might have scored big in these put options, but who's to say the ABC pattern is not going to happen? It could happen. So long as the ABC prospect is still in the table, the bears cannot afford to be too arrogant here. And then we have the SPX, the daily chart for the cash index for the S&P 500. Again, the chart lost 4,114.65. That is a loss for the bulls, but it remains above 4,000. We have a gap. That would be support number one. And then we have 4,000. That would be support number two. The bears are not going to start shorting for real until we see 4,000 lost its support again, and the chart closes the day below 4,000. Here's the Qs, the Nasdaq, 30 minutes chart. It went higher, almost to 313 again, did not make it above 313. This is a bad sign. And then it went down to the support of 307.41, lost that support, yet managed to recapture it. However, by the end of the day, it lost that support once again. Is this bullish or bearish in nature? The answer is it is bearish. Because the bears would argue, what if this is a reverse ABC pattern, which should take us all the way down to close the gap at around 299.28, or even get us down all the way to 297.5 as support. But the bears have to keep in mind that the daily chart for the continuous contract for the Nasdaq remains positive, at least for now. We have the volume moving down. We have the momentum indicators remaining positive. We still have the support of 12,207. We're battling 12,766 as resistance. Now, that doesn't mean that the bulls have lost the battle, because what if this is, yet again, another ABC pattern, just like we talked with the SPY, the S&P 500. The bears are not going to be emboldened to short for good, being too aggressive in the shorts, until we see 11,689 lost the support for good. Here's the IWM 30 minutes chart, gapping higher, yet losing the momentum, and then losing the support of the gap of 182.81, yet it managed to close above the support. So the Russell appears to be a lot stronger than both the SPY and the Qs. Now, does that mean that the IWM is out of the woods? Of course not, because the bears would argue that this is a reverse ABC pattern. Sooner or later, 182.81 will be lost to support, and down we go. And here's perhaps the reason for the weakness in the equities market today: the dollar index, a daily chart. It appears that the dollar is bottoming for now, and it is moving its way higher in order to reclaim 103 as support. If that happens, it would not be a positive development for equities. It would certainly not be positive for gold, because gold is battling to keep the support at around 1,840, the Fibonacci support. The gold bugs are looking for a higher low, because that would keep the hope alive. But if the chart goes down, losing 1,840 as support, making a lower low, that would be a negative development. Are you going to wait till you see a lower low to happen? Or are you going to bail out the moment 1,840 is lost as support? That decision is up to you entirely. Now, what about UK oil? Brent, this is from a 4 hours perspective. The battle of 114, 115 was won, and then we got to 118, and the chart battled that resistance over and over again for a few hours, and then it popped higher, all the way above 120 to 124, even 125 almost, and then came the fake news from the Wall Street Journal, killing the rally, and now the support of 118 is lost. The chart is battling in an attempt to reclaim 118 as support once again. If that battle is lost, then who's to say that this is not a reverse ABC pattern that could take us all the way down to the trend line of support, and that would be a bad development for crude. But the hope remains alive if crude managed to crack above 118, reclaiming that level of support once again. Here's the daily chart for the 10-year yield. We got the support of 2.72. The chart bounced from that point on. It caught support. This is not good news for the equities market, certainly not good for the NASDAQ. So the weakness that we got today is due to the rise in the dollar and the 10-year yield. And this is not going to be good for the TLT by default. Here's a daily chart for the TLT. The bull flag rally is gone now, but the hope is still alive from a weekly chart perspective, because when you look at it, what if this is an ABC pattern? We got the A leg, now we're forming the B. Who's to say that the C leg is not going to take us all the way to 125 at minimum? Here's the VIX 4 hours chart. What's going on here? No development at all. No update here. So we're going to move on to the VXN 4 hours chart. No update here. Nothing is going on. So you cannot make major decisions in your trading one way or the other, because the volatility indices are not giving you a green signal one way or the other. Here's Apple, a daily chart. It remains positive. It is battling 150 as support. The volume is down. The momentum indicators are improving. So far, so good for Apple. We become bearish again if the support of 145 is lost for good. Matter of fact, to be conservative, if the gap is closed and Apple refuses to bounce, and that gap is at around, let's say, 144, 143 and a half, if the chart goes down there and it fails to rebound, that would be a bearish development. What about Tesla? 30 minutes chart. We got a bear flag yesterday. The bear flag played out, and now it appears that we have another bear flag that could take us all the way down to close the gap at around 700. Now, before Tesla bears get excited, watch out here, because the bulls could zoom out to a daily chart and they could argue it doesn't matter if we have a pullback all the way to 700. So long as 700 remains intact as support, who's to say that we're not going to see a reverse head and shoulder pattern, which will take us higher anyways? Now look at the momentum indicators. We have positive green impressions on the histogram of the MACD, indicating positive momentum for Tesla. And lastly, what about tulips? BTC. This is a heartbreaker, because you got the break over the weekend. Not the heartbreaker. You got the break of the pattern. The pattern was negative. Bitcoin was asking, any buyers, any buyers, any buyers. Apparently, certain buyers showed up over the weekend and everybody got excited. And if you bought the dip after you saw the massive candle, the buying, you did the right thing. And therefore, I call it a heartbreaker, a bull trap, because all of that rally got erased today and 30,000 is now lost to support. Why is this significant to the stock market? Because Bitcoin is a risk-on, risk-off indicator. Well, if Bitcoin refused to rally, fails to rally, and on top of that lost 30,000 of support again, that is a risk-off signal, not a risk-on one. But rest assured, you got the pumpers at JP Morgan once again, even though the CEO, by the way, gangster Jamie Dimon, came out today and said hurricanes and storms like a weatherman coming to the economy. But JP Morgan says that they see upside for Bitcoin after recent washout. We'll see what happens, but for now, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the most important ADP employment report. That would be an appetizer for the upcoming payrolls on Friday. And then we have unit labor cost. This will be important for inflation. We have factory orders. And then we got another zombie from Cleveland, Loretta Mister speaking. We'll see what she says. But folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.